Welcome to the Killik & Co podcast for Monday the 15th of September. The diary today looks a little bit thin, but don't be deceived. There's a lot of very important stuff here that will influence the direction of markets for this week. We start off, of course, on Wednesday with the Bank of England minutes. Last time around, these minutes revealed that of the 9 members, 2 of them actually voted for a rate increase, and so the key here, of course, is presumably the same 2 will vote again at the last round for a rate increase. Will anyone else have joined them? That will, of course, influence the sort of timing or the expectation of timing of the first rate rise. I think more importantly, however, we turn to the US, and here we have the Fed statement, the 2-day meeting, and this, of course, is accompanied with Janet Yellen, the new chairman of the Fed, who will be giving a speech. Towards the end of last week, it was notable how the events were starting to move towards this meeting, in the fact that they're expecting a more hawkish tone. Up until now, this thought of when rates will increase, the use of the word considerable time is expected to be dropped from that statement, and really maybe a roadmap laid out for the first of those sort of tightening of rates. Certainly the unwinding of QE is very close upon us now. So very important in the US, and then we turn, of course, to the Scottish referendum, which in itself is building up quite a head of steam as the voting polls over the weekend look so close, too difficult to call at this stage, and therefore really subject to vulnerability to that sort of investors, or certainly voters, who are undecided at this stage, certainly seeming to be a large number of those that could influence. And so really all of these things coming together, it's going to be quite a powerful week, and equity markets have started a little bit in the red this morning in advance of that. If we start to just look ahead to what is sort of some of the key charts, just look at the way that the US 10-year yield started to sort of hike quite a bit higher towards the end of last week. A very material move off of that low trend. We've been commenting recently about the fact that these yields were continuing to push lower, but they've spiked quite sharply higher just in the course of the last few weeks. So this is, as I say, in ahead of this sort of Janet Yellen, the Fed meeting this week, really is an expectation that we're going to see a more hawkish meeting, and so quite notable how that began to move. And then also just take a look at some of the currencies. This is the all-important US dollar versus the Japanese yen. This is representing yen weakness. So again, just highlighting what we were commenting upon last week, and our recently introduced note that we're starting to see a breakout on some of those key metrics for the Japanese market at the moment. This is very beneficial to the Japanese economy, given that it is largely an export-based business, and as a result of that weaker yen is making many of their goods much more competitive on the market. But it's dollar strength, which is being seen across the board. It's dollar strength against the euro, dollar strength against the sterling, which is being driven to some extent by the expectation for more hawkish comments this week. And what we are seeing, and we haven't seen up to date, is that we're seeing more volatility in rates and also in FX. We're not seeing it in stocks at the moment. The stock market still remaining relatively benign to the whole situation, but certainly as we start to see these movements in currencies and also in rates, in yields, it is beginning to become just a little bit more sort of disjointed as we head to these sort of important meetings this week. This is the euro, and obviously that commitment to the cheaper euro is continuing at the moment, going sub 130 last week and holding around 129.32 at the moment. Good for the euro. This is good for the European economies to try and sort of make them competitive, to trade out of their sort of current lackluster economic performance that we're seeing. So continuing to see some relatively good performance out of equities in the euro markets, despite the weak macro data that we've seen both on inflation and on growth, and indeed on some of the sentiment indicators through many of the economies at the moment. Sterling has been weak. There's obviously a lot of noise ahead of the Scottish referendum as to sterling's weakness at the moment, but in fairness, sterling's weakness is really just in par for the course that we've seen elsewhere in the world with dollar strength. So how much of that you can actually ascribe to the Scottish referendum is difficult to judge, but expect volatility in sterling this week ahead of that outcome that we're expecting. Result of that Scottish referendum is expected early on Friday morning, and just on that morning we will have quadruple witching hour, whereas where the futures and options all tend to unwind. So Friday promises to be a little bit sort of volatile for stock markets, particularly here in the UK. Just commenting upon the fact that whilst we're seeing that volatility in those other asset classes, stocks remaining relatively benign to it, and the S&P 500, okay, it shied away from the 2000 level that it got to towards the end of the summer of August, and just dipping a little bit lower this week, but it's not bouncing around too much at the moment, and whilst we're in a relatively quiet patch for corporate results, we've got one or two that we're expecting this week, but nothing of any particular note. It's encouraging to see that we're in sort of a low volatile period for stocks. Question, of course, can it last given what is going on elsewhere in the market? FTSE 100, well, a little bit more weakness that we've seen in the FTSE 100. I think the Scottish referendum is undoubtedly playing its part here. It's notable that stocks that have got some exposure to Scotland, be it the banking sector or indeed some of the industrials that reside in Scotland, they have been a little bit weaker last week. The relative underperformances were coming from those sort of stocks. So having sort of got back up to the year highs and perilously close to the all-time highs for the FTSE 100, we're shying away quite quickly from that level. It really does need to break that 6,900 level. This chart only goes back a year, but if we take it back really over 10, 15 years, it really is that sort of that level that we want to break through and really have a shot at the 7,000. But we've failed again, and that's probably about the fourth or fifth time this year that we've failed from those levels. We'd like to see it break through. Euro stocks, well, similar pattern there, and again, just really serving to highlight that it is for us an area of interest, because whilst we are seeing that declining euro at the moment, people will be, or investors will be looking to buy European stocks, and so we have got some relative strength coming through in euro-based stocks at this stage. And finally, just a quick comment on stocks. Specifically, we talked about Apple last week. The launch of their new iPhone 6 and 6 Plus, plus the Apple Watch, were reasonably well received, actually. Expectations were quite high going into that presentation, encouraging that the stock price managed to sort of, after an initial dip, recover quite well and holds quite strongly towards the top end of expectations. Initial orders that are being seen through the likes of Vodafone, comments have been come back, are very strong, so there has been appetite for this product. And finally, just a quick note on one of the features for this morning, SAB Miller, FTSE 100 company. Not so widely owned, but in the drink space, there's a lot of M&A activity, and it was revealed this morning that they've been approaching the Heineken family about a potential takeover. That's been rebuffed. Heineken wish to remain independent, but the shares of SAB Miller, as you can see there, up about 5% this morning, and really the feeling is that actually it makes them vulnerable now to potentially a bid from Anheuser-Busch. As I say, plenty of activity on the M&A front in the drink sector around about at the moment, so one to keep an eye on.